Manish Gunwani joins us with Reliance, I beg your pardon, with Nippon AMC to talk about where he feels markets are headed. Are we in for some kind of a disappointment because of the second wave of COVID during the earnings season? And what exactly is the moot point with retail investors? It's good to see that outflows from domestic institutional investors have finally become inflows. Manish, fantastic to have you back. Thank you for joining us. With all the drama and with all the concerns which were centered around inflation and US Fed, global markets and Indian markets have managed to climb the wall of worry. Are you surprised? Because inflation historically has always haunted equity markets, and right now everybody is saying, yes, we know inflation is high, but we know it will come down also.
So, because I think that is one part of it. The other part is that unlike in the past, I think India is also running low real rates, right? I mean, while inflation is high, your interest rates haven't gone up. So that is theoretically a great combination for equities because inflation gives you top line growth in corporate earnings, gives you profit growth. But your discounting factor or your PE multiple actually remains high because your interest rates are low. So I think that is probably a big part of why markets have remained healthy right through the COVID second wave. But I think the fascinating thing is related to what you're saying is that globally the bond markets and maybe the equity markets are looking at things differently. So in fact, if you look at inflation expectations in the US, they've started falling. That typically is a bearish signal for growth, for inflation, for commodities, etc. Whereas the globally equity markets are still pretty optimistic. Although again, globally, I think sector rotation has happened from a bit from commodities and cyclicals back to FAANG stocks, etc. But yeah, I still think that that is a bit of a fascinating divergence at this point of time. That the US 10-year yield has actually fallen quite a bit, right? I mean, so it is a kind of predicting that the whole reflation trade is past its peak, but I don't think equity markets are looking at it that way.
Manish, we will soon be hitting the earnings season, and this time the general view in the market is that the impact of the second wave will be felt and corporates will be more vocal about indicating or perhaps admitting that yes, the quarter gone by is almost like a washout quarter. Are markets prepared for that? Are markets prepared for a poor earnings stroke management commentary?
In fact, Nigun, I really don't think April to June results will matter that much. So there are multiple strands to this. That one is, of course, anything exposed to global economy should have done okay, right? Because the second wave was a very India-specific phenomenon broadly, right? So sectors like IT, etc., should have done pretty okay. In terms of domestic sectors, market, I think, will be forward-looking. So it's more about the commentary or the real-time demand which corporates are seeing. It will also be about how much raw material pressure is going to be passed on, what is our outlook on margins. And as an investor, I probably think the challenge not is looking at the April to June quarter. I think going forward, the challenge will be that there will definitely be a lot of pent-up demand, assuming that the good things that are happening on the virus front recently continue and slowly it kind of dies down. The challenge will be to figure out what is pent-up and what is recurring, because in a lot of sectors like travel, etc., I think the pent-up demand is probably 15 months, not because we just had a narrow window from probably November to Feb, which was okay. But if this time, because vaccination is there, if at all the confidence to travel is higher, because people know that vaccination will protect them. The challenge to my mind will be to figure out how much will be pent up and how much will be recurring, or what kind of earning growth will actually be the long-term earning growth rather than just a reflection of pent-up demand.
So Manish, if I look at the portfolio and what is there in the public domain, I can see a lot of cyclicals have made a comeback, a lot of corporate banks have made a comeback. Now there is logic in buying that. There's logic in buying cyclicals and industrials because economy is on the mend. But my follow-up question is that isn't the trade getting very crowded? Because just about everybody from a retail broker to an HNI investor, from a strategist to a senior fund manager like yours, everybody is suddenly bullish on industrials and cyclicals.
No, you have a point, because I think there needs to be introspection, because obviously it's becoming a bit of a consensus trend. So let me just give you a couple of thoughts. One is you have to take into account, as I said, that the global bond markets are not that optimistic as some of the equity markets are. You have to take into account that some of the global bellwether stocks like Caterpillar have corrected quite a lot recently. ArcelorMittal as well. So those, first of all, those things have to make you think about this. Also, I think that I would just try to differentiate a bit about, I think the global cycle is probably where I would be a bit more cautious right now. I think the Indian cycle is in early stages, both from a near-term perspective and from a medium to long-term perspective. So what I mean to say is that, look, the US economy has been doing well for last 8-10 years. It had a bump with COVID, it came out of the bump. But in terms of, corporate profits to GDP or capacity utilization, obviously the US economy is far more advanced in the cycle. When you look at the Indian cycle, first of all, from a near-term perspective, we had 2 COVID waves rather than 1 COVID wave. Second, more importantly, for last 5, 7, 8 years, our corporate profit to GDP has been falling. We've had huge underutilization in many big sectors like power, cement, whatsoever. So now I think we are coming out of a fairly long down cycle, and we have a good combination of macro factors to drive growth, right? So we have reasonable, very strong global growth, which also feeds into Indian growth. You have low real interest rates, you have reasonably high fiscal spending, and you have a huge pent-up demand. Now, it's literally like saying, if India can't grow from here, then we don't know when India can grow fast ever again, right? Because with this kind of combination, it'll be difficult to see why India should not have a very strong economy for the next 12 to 18 months. So you're correct that there is a bit of a consensus building up on cyclical, but I think the domestic cyclicals are, to my mind, a bit better placed than the global cyclicals. Global cyclicals, I mean metals, auto exporters, etc. I would be a bit more worried about them than maybe selectively banks, cement, real estate in India right now.
Okay, fair enough. Talking about banks then, Manish, I see a little bit of churn in terms of the financials that perhaps you're picking up, and some perhaps that you've booked a little bit of profits in across your funds. Share with us the rationale there. What's looking attractive across the financials to you, and why?
So on the financial side, one of the themes which we've stuck with last 4-5 years, it's worked. It didn't work initially. Now, last 1-2 years, it's worked pretty okay. Is going in for the value banks. It used to be called corporate bank, but honestly, right now, their retail book is reasonably large. So maybe corporate bank is a misnomer. So the low price to book, but the very large banks, let's let's put it that way. That theme we still believe has many legs to go, because it's not only about, one is, of course, the big part is credit quality reverting to the mean. The corporate book is obviously very clean right now because of the pain it has gone through the last 7 8 years. But also, I think a bit about technology, because as we're seeing globally, there is a bit bigger and bigger role technology is playing in determining where the profit pools are shifting in financials. And we just feel more comfortable being in these large banks, even versus a lot of small private banks, that they have the necessary bandwidth, they have the necessary resources to put up best-in-class kind of technology. So that remains, we remain positive on both sides of insurance, life, and general. NBFCs and small private banks, given what I've said, we tend to have a bit of a cautious view, not only again from a cyclical perspective, but from the fact that scalability of these business models beyond a certain size becomes an issue. The technology part is becoming an issue. I think those segments, our view has broadly remained the same now based on valuations. Of course, we might have trimmed some part of the financials here or there, but yeah, I think these have been pretty much our structural views for quite some time.
Okay. In terms of the reopening, Manish, and the kind of recovery that everyone's anticipating, over the next couple of quarters, I know you touched upon the global picture and, in terms of, monetary policy or in terms of what we might see going forward on inflation. But what about more near-term risks, a third wave, so on and so forth? The market seems to be very confident right now that things are only going to get better from here. I mean, most of the reports coming in, or most of the consensus at this point, seems to be firmly with a clear recovery from here on. Do you feel perhaps we're perhaps being a bit short-sighted and not factoring it in, or is this something that has been taken into account?
No, I am not so worried from a normal business as usual context. As I said, with a combination of strong global growth, low real rates, reasonably high fiscal spending, and a very low base. See, our base is not only low from a 1 or 2 year perspective, but even from a 5 8 year perspective, if you see the usual metrics to track, which is basically your car sales or bank credit growth, we have been undershooting potential for almost 5 8 years. So I think there's a reasonable thesis to say that finally we will come back to potential, which even today can surprise people. So if I take, let's say, for example, 20-year CAGR of bank credit growth rate in India, it'd probably be somewhere between 13-14%. If you see the broad estimates of credit growth on the sell side, etc., no one's really penciling in anything above 13-14%, even 2-3 years down the line, right? So it's not that I don't think the estimates are very aggressive. If at all, we're reverting to the mean. Obviously, if you argue that India has structurally gone down in nominal GDP growth, that's a different argument. But yeah, I mean, I'm saying the ask rate in cyclicals is not very high at this point of time.
Right. Manish, wanted to understand the damage or the dark side of the commodity uptick. While sure, metals have had a great run since the start of 2020 to now, but the RM cost pressures on, consumption, more importantly, on autos, discretionary spending items. Most of the companies that we've been chatting with have already done the damage control. Unilever has, categorically mentioned on open forums that they're going to be taking calibrated price hikes. As recent as this week, you've heard from Maruti, which has undertaken a third price hike this year itself. Hero MotoCorp yesterday announced price hikes as well across categories. You think that price adjustment of RM costs weighing heavy and that getting passed on to customers, has that happened across the discretionary segment?
To a certain extent, yes. The comfort I take is that, first of all, inflation by definition is year on year. And when we're looking at earning estimate, either short term of 1.5 year or long term, see, if you just place yourself, let's say 6 to 12 months ahead, I think a lot of inflation should be much less than what it is today, because the broad thesis again is not that steel prices or oil prices will jump up from here. They've already gone up so much. So frankly, in the short term, how gross margins do or EBITDA margins do, for 1 or 2 quarters, some of the consumer firms may face an issue. But I think the real all is not about the margins in the next 1 or 2 quarters. The real call on inflation is whether food, oil, steel, to my mind, it looks unlikely that on a 3-year basis, they will have a CAGR from here, which is why I'm pretty optimistic that inflation will come down. I think oil has technology substitutes, EV, renewable, food. I think we all know that cereals, India actually overproduces. So given that kind of context, to say that from here, let's say for 3 years, will these commodities do a CAGR from here? I would really doubt it. So I'm not so worried about inflation. I think the real call is on growth, honestly. I mean, we've seen so low growth for so long. I think the potential for growth to surprise is probably a bigger thought for me. Inflation, I think, is a bit of a rearview mirror phenomenon at this point of time.
So where within the market, Manish, at these levels, do you find a confluence of growth as well as good pricing?
So obviously not a distant pricing. All of us will have the memory of April 20, and most of the stocks are 2x plus from there. So obviously, if you anchor to that, we obviously will not find stocks attractive. But as I said, when I look from a 5-year perspective, that what India has done, and if I say 3 years or 4 years, not even full reversion to mean happens. So whether you look at commercial vehicles or banks, I think the earning growth should surprise. Overall market earnings from FY21 to 24, unlikely that it will be below 18%, 20% CAGR. So if that kind of earning growth comes, and I think the call on domestic monetary policy is also important, that if you're going to remain low real rate, I mean, it's not a classic values fund manager's dream market, obviously, but point is that if earning growth is going to be strong, even if you pencil in a bit of P compression, which should happen, because globally, if US 10-year yield goes up, I think you have to pencil in a bit of a P compression going forward. But if earning growth is going to be strong, honestly, I don't see why you should be very pessimistic.
Manish, would you go against the global trend and buy power companies, utilities, ITC? There is a school of thought which says, do not buy NTPC, it pollutes. Do not buy ITC, it is in the business of tobacco. Do not buy anything which is not environmental friendly. In India, do you think ESG investing is here, or one should actually think the other way?
No, I think clearly ESG is too strong a trend to say that it is a fad. Obviously, it's going to become an intrinsic part of DNA of most companies, whether it's financial company, non-financial company, I think ESG is too big a thing to see it from a short-term perspective. The stocks you mentioned, honestly, we have also grappled with them. Clearly, we have exposure to some of them. Yeah, I mean, there's just too much value to ignore, but at the same time, there are obviously terminal value considerations as well in a lot of these stocks. So we're not heavy there, but I think depending on a fund manager, we do have a bit of exposure to them.